It's now time to dissect our topic of the week. At what point are members of a market involved in irrational exuberance? That point where speculation has detached markets from all reality. And what do previous crashes and market panics teach us? Who better to tell us than Roland and, of course, Kirby. Gentlemen, welcome to the program. Crashes, market panics, pessimism, volatility, and this is what we're experiencing right now. We're just looking at the negative economic data. We're worried about what's happening in Europe and the US. And this, of course, again, something that we experienced because of the 2008 crash. Let's start off with you, Kirby. I know that you're quite an optimist because you look at the longer-term picture as opposed to just today. Yeah, I mean, we're going to look at some longer-term pictures for markets a little bit later on, and I'll show you why I look at the long-term rather than the short-term. Just by the way, I mean, you mentioned Allan Greenspan there, and I mean, it's worthwhile for anybody to pick up his book and to read. If you at home want to read his book, it's called Age of Turbulence, Adventures in a New World. It's actually an autobiography that Allan Greenspan wrote, and it's a fantastic history on the world, so to speak, for the last 100 years, and just from an economical perspective. And I mean, one of the things that he talks about is irrational exuberance. And one of his big problems in the book, as you read it, is at what point does this become irrational exuberance, and at what point is it just mere speculation? Because he says speculation is pretty good for markets. It creates the revenues that you see from new listings. It creates a tax base. And, you know, at what point does the momentum stop? Or at what point does it become irrational exuberance, and then where you then have a momentum that stops and it literally just falls off a cliff? But Kirby, I mean, Allan Greenspan, and using him as an example, we know that he actually lost quite a lot of credibility because he was said to have contributed extensively to the 2008 crash because of the bubble that was created by keeping rates too low for too long at 1%. You see, the thing is, I think that central bank governors' main job is that of monetary policy. It's not so much trying to pinpoint when the next bubble is going to occur or potentially when there's irrational exuberance in the market. It's very, very difficult to pinpoint these things. Often irrational exuberance is something that you see and something that you feel when you look at markets for long enough. And unfortunately, the signals aren't always that clear. One of the clearest signals, though, that I've found for irrational exuberance in markets is capital. When you've got superfluous amounts of capital in the system, you create room for ills to happen in the market. Cheap capital. Cheap capital. Exactly, and this is what happened right in after the dot-com crisis and, of course, after 9/11. What do you pinpoint as irrational exuberance in the market? Can you identify it, Roland? Probably in the last 10 years, there's a whole category of research that is focusing on this kind of, it's called behavioral finance. In other words, trying to measure the behavior of the market or of investors. And it's absolutely fascinating research. And generally, the way the thinking goes in this research is that when prices move, there are two reasons why prices move, generally speaking. So that the one reason is due to fundamentals or some kind of economic news that contributes to share prices or the market going up and down. But in addition to that, there's a secondary effect embedded in the price moves, which is due to what we call sentiment. And when that sentiment dominates the movements rather than the fundamentals or the economics, we start getting to situations where it can compound itself and sort of fear breeds fear and greed breeds greed kind of thing, and you get into these irrational bubbles. So it's actually very interesting and very powerful to separate out of the market how much of that return is coming from behavior and how much is coming from actual fundamentals. Okay, so in hindsight it all makes sense, but right now, Kirby, looking at the past, can we say that most market crashes have very similar elements to them, that they're actually perpetuated by greed, and therefore we see a bubble within a specific industry, and once we start focusing on the fundamental factors, then we realize that, okay, this is actually getting too hot? Well, I mean, I think there are certain bubbles which are created predominantly because of greed, and there are certain ones that just happen because there's just too much capital in the system and something has to give. You know, Black Monday is a great example of one of those crashes that happened, where there was, today, people are still looking back in time and saying, well, you know, what were the reasons behind this? You know, why? It's a technology factor as well, interestingly enough. Yeah, absolutely. But, you know, there's nothing that you can pinpoint and say it is exact, you know, it's this one thing that kind of created it. One thing that you have to be very scared of, and I say this, is when there's too much capital in the system, when things are going too well out there. It's when most of the analysts are sitting and forecasting a fantastically rosy future rather than, you know, kind of doom and gloom. If you look at the situation that we're sitting in right now, this is doom and gloom. There isn't that much that's happy, that's kind of that's on
on the horizon. And people want certainty before they invest. And invariably, this is where you kind of pick up the investment bargains that you that you see. Let's just maybe look at some crashes over time. And if you have a look at the first graph there, by the way, we're quoting a bit of work. It was done in 2009 by Paul Kaplan in his paper, The History of Economics of Stock Market Crashes. You can get your hands on a copy of one of these by just going to the CFA Institute website. You can actually download it there. And let's just have a look at an extract from that. And he goes back to 1870 here, where he looks at the American market, and he shows the run-up in the market over time. Now, the interesting thing is, and again, this shows us quite clearly, that if you invested over time, you actually make money out of markets. The thing that's quite tough to actually live with at the moment is if you look at this period that you see at the top end over here, which is kind of from late stage 2000 up to now, the total return on the S&P 500 has been in the order of about -1%, very similar in the Dow Jones. But if you just look kind of through the whole cycle, there you can see the Great Depression happening. There's some post-war bear market happening over there. There's the inflationary bear market of 1973. Yes, all on their own, they're fairly large movements, but so to speak, if you just look at it, through time, you actually make money. Let's apply this to the South African market. If you have a look there, there's the all-share index, and I just go back here to 1970. Again, this doesn't come from the work Paul Kaplan has done, but it certainly just shows you what the picture of the South African market looks like. Again, long term, you see that 15% compounded return kind of taking over, and if you invest it over time, you make money out of these markets. In the short term, well, it's kind of your guess what you're going to get. If you look at those events that you see over there, those are the subprime crisis and the global financial crisis. These periods over here, there's 9/11 and then the SARS outbreak and the Iraqi war that happens. If you look at this period over here, there's another example. There's Black Monday happening in 1987. So certainly, they are going to be with us for all time to come. Crashes happen, these things, kind of, it's part and parcel of what markets are. So if we're going to try and do away with these things, we do away with what markets are.
But some say it's different this time because of all the debt overhang that we're seeing from a sovereign perspective, which of course has been shifted to corporates and then going to be shifted, of course, to the consumer at the end of the day. Is it different this time around? And take us through, the history of crashes. Does it look any different today?
Well, every time it is different in terms of the fundamentals and the economics, but there are certain common traits in markets that can be identified. For example, again, recent research is showing that something like volatility is actually a lead indicator of irrationality in the market. So something like the VIX index, there's studies to show that when volatility suddenly starts behaving differently, because volatility clusters, there are times when volatility is quite quiet, and then there are times when volatility starts breaking out in different ways. And often that can happen, not always, but often it can happen slightly before there's a major correction in the market. Some of the work that we've done is looking at the Rand, and if you look at the Rand's volatility on a sort of rolling basis, every time the volatility starts getting less and less and less, in other words, the Rand becomes more and more stable, the chances of there being suddenly a blowout again are increasing more and more, and that's exactly what we've seen in September and August.
Absolutely, and the point is that we actually started to see crashes happening far closer as time has gone on. So before there would be quite an extensive period where we wouldn't see a crash, and now they seem to be happening far more often. Kirby, is this a sign of the times that we're trying to fix the problem with the very same thing that created the problem? And you hit the point, the nail on the head when you said capital.
Yeah, I mean, I think that if you look at a post-Second World War global economy, you sat with a very specific social picture of the world where people were trying to create bliss, what we call post-war bliss. And you had economies growing on the back end of that. Now, when you have economies ticking out and growing very nicely, you have markets behaving quite nicely as well, because there's always going to be, there's some form of growth. What we've literally seen over the last decade is that growth has literally become stunted. And the overhang of that is this debt issue that we're seeing, and mostly pronounced in Europe and most of the Mediterranean countries, but also pronounced in the East and in the US as well. So when you have that kind of uncertainty, you have more crashes happening. And they might not just be crashes, but they might just be markets going absolutely nowhere or petering out over time. If you look at the one-year numbers on the Dow Jones, the S&P 500, and you potentially look at those in Europe, those certainly look quite negative relative to what has happened in emerging markets. Most companies, and there's a whole horde of them, are back at kind of high single-digit type PEs. And they were there in 2008. And earnings, regardless, have kind of continued to increase. So as you don't have a stable economic environment, you can't expect markets to be stable on the back end of that as
Why
well.
has the US just not recovered over the past 10 years? Because at the end of the day, the Dow Jones, and you mentioned it earlier, the S&P, has done very little over the past 10 years. Very different scenario that is playing out in emerging markets. Can we attribute this to the fact that just growth in that economy hasn't really shot the lights out?
Well, I think that firstly there hasn't been growth that you've seen in China. Okay, so I mean I think that's certainly a contributing factor. But I think the biggest single factor is the fact that most US stocks going into 2000 actually had very elevated price to earnings ratios. So you were paying dearly for growth, during that period, and you've just seen those kind of just slowly petering out and coming down as earnings have increased and the markets have literally gone nowhere. Again, my old adage: buy cheap, get return; buy expensive, get no return. The interesting thing is that you get you had a lot of people in the last decade saying in America specifically, listen here, if you pay up for these companies, it's okay. It's in the Western economy. You're actually going to get good returns because there's less risk as compared to, say, an emerging market in South Africa. But it seems like the price to earnings relative to its return relationship is just halt.
Do you think there's another crash imminent?
I don't think there's another crash imminent, but certainly the likelihood by what the market is doing, and often the market is a good lead indicator of what's going to happen to economic growth, is telling us that growth is going to slow and we potentially are heading, or that the double dip is more likely. That doesn't mean it's going to happen, it just means it's become slightly more likely. But we're not seeing any of the major risks that we saw in 2008 currently. So I'm not expecting a recession coming forward, but we're going to have these kind of bubbles, micro bubbles in this recovery period. The longer the party, the longer the hangover, right? So we're probably going to be bouncing around for another few years. But we're going to expect
more volatility, essentially. Is that what you're saying?
Absolutely. I think whenever there's too much focus on the sentiment and not on the fundamentals, which we're seeing at the moment. And just to come back to what Kobie said earlier on, buy cheap and get returns. What we're seeing at the moment is that value stocks, which always have a lower PE than the market, that's why they're cheaper. That discount that value stocks are trading at relative to the market is even deeper now. And what that is telling us is that people are not wanting to take any risk anymore. So we are stuck in this kind of environment where the market is saying, from a sentiment perspective, taking risk, I've burnt myself 2 or 3 times since the subprime crisis. I'm just going to take my money out of the market and sit and watch. So when cheap stocks become cheaper, it is telling you that the market is, from a sentiment perspective, still very negative.
So you're saying we've priced in possible bad news?
I'm saying the market currently is very negative about taking any risk, and we haven't seen any recovery in that yet.
Well, see, get a default in one of the Mediterranean countries, potentially, you're going to see markets selling down on the back end of that. But there's no news, I think, that's in the market today that is going to put people into denial, where people say, I didn't know this is going to happen. This is all on the radar screen, and when things are on the radar screen, markets generally price things in.
Would the big unknown be a break-up in the Eurozone?
Yes, that could be an unknown. That could be an unknown.
There are 2 effects. There's the developed market effect and the emerging market effect. And I think we are sort of, as has happened in previous times, quite decoupled when there's stress in developed markets. But if this current stress in the EU and in the US swamps over into emerging markets, that's when we're going to get hit. And we're not seeing that yet. So I think we are quite isolated, and that's in our benefit.
That's very true, because the S&P, and we've been talking about this for quite some time, is actually down 20% year to date. Yep. They say it's officially in bear market
we're down
territory.
5%.
And we're down exactly just over 5% year to date. So we've actually significantly outperformed relative to,
happy days for South African
the US
investors.
market, absolutely.
I mean, that's been, and that's, again, that's the, maybe that wasn't the case maybe 10 years ago, where maybe emerging markets were more coupled with developed markets. Whereas if you look at it today, people are saying, well, hang on a second, maybe growth does happen elsewhere, but maybe, even though Western markets kind of sell down. And you may be seeing some of that. Because where are you going to, if you're an American investor today, where are you going to look for growth? Where? You have to go to emerging markets. You can't go to the bond markets.
We've spoken of the catalyst, we've spoken of the crash, and with regards to the aftermath, and one of the points actually, Kobie, that you've put forward is the political implications, the possible political implications. And I think we're seeing it on a global level, because we're talking about China lacking leadership in assisting the Eurozone. We're looking at political gridlock and deadlock within the US, and we're seeing a lot of rhetoric out of France and Germany, and then implicating the peripheral Eurozone countries. So a political element is here, because you've got to tie in economic policies with political policies as well. Is this what we're looking at right now? Because are we safely in recovery mode? And all really hinges on decisive action by political leaders. Who would like to tackle that one?
I do think that what we are seeing at the moment in the last week or so is a sudden resurgence of confidence, because finally the EU has admitted that they've got a problem and they are addressing it. So it is all about confidence, and it is all about the leaders taking decisive action, and any kind of indecisive rhetoric is immediately swamping over into sentiment. So we're not seeing fundamentals driving the market at the moment.
Okay, closing comments from you, Kobe.
Let's maybe as a closing statement, let's maybe look at some how bad drawdowns can look like. So once you hit a peak in the market, how badly do markets actually come back? And I'd like to show you this graphic again from Paul Kaplan, the work done by Paul Kaplan. And these show the largest post-World War II declines in the Japanese stock market. But I mean, it holds for Japan, but it also holds for the rest of the globe. And if you have a look here, you can see some of the declines that you see on your screen over there. When was the peak for the market? You see different peaks for different time periods over there. The declines, the trough of the market that you see on that side over there, and then when the actual recovery happens, which you see on this side of the screen. By the way, you can see the December 1989 crash that happened. You can see the decline there at 72%, and that's predominantly because of a debt overhang in Japan. You see it says to be decided still, and I mean, we know now that we've kind of eked out a slight return at basically just below 1% per annum since then. So absolutely no recovery. But if you have a look at some of the other ones here, look at December 1972 up to 1983. Some of those recoveries take, some time. In other cases, recoveries happen quite quickly. Look at 53 to 55. Yeah. Again, it's economical, it's political, and that then shows you what happens in markets. And what happens in between kind of signifies the time period that it takes.
I think you hit the nail on the head when you spoke of what happened in Japan with regards to the debt overhang, and maybe we should take some lessons from that. Just saying.